Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1384A, and today's date is September 22nd, 2017, and the title of the episode is, The Fed is Distracting Everyone from the Real Crisis. Now, before I get started, I have a couple of announcements. Yesterday, the report was not uploaded. It looks like there was a video driver that was updated on my computer, and my computer was just continually rebooting, and I had to fix the computer. Now it looks like it's fixed, so I can continue on with the reports. My second announcement is that I uploaded an interview with Phil Sloan on the X22 Report Spotlight YouTube channel. So all you need to do is go over to YouTube, type in X22 Report Spotlight. It'll bring you right to the interview, or you can come over to the x22report.com site. Scroll down a little bit, look over to your right-hand side, you'll see the video there. Or you can go to News Sentinel. It is back up and running. I am still adding news sources and fixing the site, but you can get all the news and everything. So if you haven't gone to News Sentinel, you can go back to newssentinel.com. It is back up and running. You can also go to Steemit. That's steemit.com/@X22Report. It will bring you right to the video, and you can play the video right on Steemit. Let's get into the economic collapse financial news. Now, we have been watching Britain negotiate with the EU about leaving the EU. We know we had the referendum, and it looks like they can't come to an agreement. Now, Theresa May has come out, and she is calling for a 2-year exit implementation. She's saying that it will take around 2 years and should be agreed on as early as possible. So we will see some type of exit if both parties agree in 2 years from now, or most likely even longer. So we can see right now, nothing is happening. They're not leaving. They're still part of the system. And this is what the central bankers want. They're going to drag this out because they don't want anyone to leave their system. Now, here in the United States, the Fed came out with its latest flow of funds report. And the Fed released the latest snapshot of the U.S. household. And this says as of June 30th, 2017. And it revealed that there's about $111.4 trillion in assets, and there's about $15.2 trillion in liability. So what they're saying right now is that U.S. households, they rose to all-time new highs of about $96.2 trillion. But then we need to take a little bit closer look at what they're really talking about. And a lot of this, well, this has nothing to do with the actual wealth of people, because what they've done is they've taken the increase in value of homes. And remember, this is a paper increase. Unless you sell it, it's just on paper. And they're saying that because of the housing market, we saw an estimate of about $564 billion increase in real estate values. When we look at the stock market, they're saying, ooh, the stock market increased $1.23 trillion. And this is, of course, attached to corporate equities, mutual and pension funds, deposits, and things like that. And what we're looking at is all of this wealth is on paper because no one is taking it out. It's just sitting there. It's all on paper. And when we look at it a little closer, what do we see? Well, the wealth flowed up to the top 10% of the country. The rest of the people, guess what? They're not seeing it. So roughly 75% of the $1.8 trillion increase in assets went to benefit just 10% of the population, who also account for roughly 76% of America's financial net worth. It also means that just 10% of the U.S. population is worth $73 trillion, while half of the U.S. population is worth around $9.6 trillion. So when they say, oh, look, everyone is doing better, everyone's feeling the recovery, no, everyone is not feeling this, and most of this is on paper. I mean, if the market came down, tomorrow, and real estate came down tomorrow, pensions would be wiped out, the real estate market would be a disaster, stock markets would be a disaster, and all that wealth would be wiped away because they're not holding it physically. Just like we saw back in 2008. A lot of people were completely wiped out, and that was that. So they're out there pushing this idea that America is great and we're building this wealth, and this is not true. We see that pensions, they are in trouble right now. The Ohio Public Employee Retirement System, OPERS, has been forced to consider cuts for its 1 million pensioners in order to keep the fund solvent. Now, we talked about pensions before, and we know that they are in trouble. And actually, the latest interview with Phil Sloan which is on the X22 Report Spotlight, we also talk about pensions, and they are in trouble, and people are not going to make out too well when the system completely implodes on itself. And before it implodes on itself, guess what? These funds who are expecting 6, 7, 8% type of interest on the investments, it's just not there. So what we're seeing is Ohio's biggest public pension system is considering cutting the cost of living allowances for its 1 million members. So how bad is it? Well, when we look at it, Ohio taxpayers are on the hook for roughly $20 billion of underfunding. And this is not the only pension system which is underfunded. And we went over that list before, and Steve St. Angelo, he was putting out information on the pension systems, and many others were putting out information on the pension systems showing that, yes, we have major problems, and we can see already it's rearing its ugly head. And it's not just in Ohio, we see it in many different states. And this is just going to get worse as time goes on, because right now, the Fed is not going to be raising interest rates anytime soon. And the economy right now, just because of the last couple of interest rates where they pushed up just a little tiny bit, well, it had an effect on the economy, and the economy is ripping itself apart. And if they try to raise interest rates even more so at this point, the whole thing would just completely fall apart. We see that U.S. manufacturing, well, it's an increasing drag on the economy. After 5 straight months of gains, the U.S. composite PMI dropped back below pre-election levels. And as market notes, there were signs of underlying fragility in September, with new orders expanding at one of the slowest rates seen over the past year. Latest data also indicated that new export sales remain close to stagnation. Despite the ongoing collapse of hard economic data, they keep pushing the soft data up, saying that everything is going to be fine. But when we look at the hard data, we can see that everything is not fine. Everything is completely falling apart. Now, the Federal Reserve, they put out their press release, and they had this 2-day meeting, and they said, okay, this is what we're going to do. We're going to start unwinding our balance sheet. We're not going to really touch interest rates right now. And they're making it like everything is fine in the economy, that everything is going perfectly well, and this is what they're going to do. But while the corporate media is making this huge, gigantic, big deal over this, over their so-called balance sheet reduction, which starts next month, let's look at some facts here. First of all, the Fed plans on shrinking its balance sheet by, 10 to 30 billion per month? The Fed balance sheet is around 4.5 trillion. So at this pace of unwinding, it would take somewhere between 13 and 33 years for the Fed to normalize its balance sheet back to pre-2008 levels. And this is with them not buying any type of bonds or doing anything else. And secondly, the only reason the Fed is even discussing a balance sheet reduction is because stocks are soaring. The second that stocks begin to correct, multiple Fed officials will appear on TV, they'll be out in the corporate media, and they'll tell you how it's time to slow the pace or even halt its balance sheet reduction. The reality is that the stock market is the only thing the Fed can point to as a success. The economy from 2008 to 2016 was the weakest recovery we have seen in the last 80 years. And right now, we're in this illusion that everything is fine. I mean, Fed Chair Janet Yellen admitted publicly yesterday that the Fed takes account of asset prices when it comes to rate hikes. In Fed speak, asset prices equal stocks, and that's the number one focus for the Fed when it comes to their monetary policy. So what does this all mean? The Fed is going to engage in some symbolic shrinking of its balance sheet, but the second that things start to fall apart, they are prepared and ready to turn on stimulus, to stop the unwinding, and it's really not going to make a difference. This is why they pick such a small amount, because they know that they will never unwind the balance sheet. They're using propaganda to make everyone believe that they are really doing this and the economy improved and everything is fine. And that opens the door for the real crisis, the crisis of inflation. And we talked about how they manipulate inflation. They're not really calculating real inflation. They're pushing it into the market. They're pushing it into real estate. They're pushing it overseas. They're pushing it everywhere else. And right now we can see the US dollar is imploding. It bounced a bit because of the Fed announcement, but it's in serious trouble. We see other countries out there, and they are moving away from the dollar. So the real crisis is the collapse of the US dollar. They're distracting everyone by making everyone believe that the economy's fine, they're going to be unwinding. In the meantime, what is happening? Well, basically all these other countries are saying, we see what's happening. We're moving away from the dollar. Now, since the Fed unveiled its plan to unwind the balance sheet, what do we see happening? Well, the U.S. Treasury yield curve, it has collapsed. The yield curve has crashed to its flattest since 2007. In fact, the bonds collapsed to just 91 basis points, which places the yield curve right at the start of both of the last two recessions. So, do you need to invert the yield curve to see a recession? In fact, we're already there. And once again, everything that we're seeing and everything that we're looking at GDP numbers. We know they're manipulated. We know that unemployment numbers are manipulated. We see retail falling apart. We see housing starting to decline. We see pensions that are in trouble. We see the tax receipts coming into the government. They are declining. The state tax receipts, they are declining. All of these things, and there's a lot more, and all these economic indicators that we continually look at tells us that this economy is a gigantic illusion, and the Fed is trying to distract us of what is really happening here in the United States and around the world, because the amount of debt and what they have done over the last 8 years or so, they have created bubbles, they've created debt bubbles, they've created an economy that cannot survive at all without the central banks keeping the interest rates low and continually pumping in free money. Because once they stop this, it falls apart. And the economy is going to fall apart no matter what. Because, again, you cannot continually pump money into the system if the real economy is dying. If people don't have jobs, if people are not spending, if people aren't feeling comfortable in their everyday lives because they can't find the jobs, everything is dependent on that. Yes, you can keep the stock market up. Yes, you can pretend that these statistical numbers are great. But if you have millions upon millions upon millions of people out of work, and they're not making money, and they're not putting it back into the system, and they're not buying retail, because if they don't buy retail, you don't need manufacturing. You don't need the automobile manufacturing. The only way they get around it now is because people have to take out loans for it. They're not actually using their own money. They're getting loans to buy those products. But the Fed, the government, they can't do anything with the everyday purchase of retail products. This is why we see it falling apart in that sector first. It will spread to the automobile market, which we see it happening now because people can't make their payments, and it's going to spread even further to the housing market. The whole thing is going to come down because what we've been seeing and what we've been watching is that it's a slow deterioration of the economy. And as we continue on, and as more and more people lose their jobs, and there's no manufacturing coming back to the United States, they can't do anything. Yes, they can pump in more stimulus, but guess what? When you have the entire economy out of work, it's not going to make a difference. And there's going to come a point where all of a sudden they're going to say, okay, there's 100-something million people who are out of work. This many people have part-time jobs. Retail is just imploding on itself. Nobody's buying houses anymore. The cash that was coming in from China, that is completely drying up. We're going to see something happen very, very soon because we're at this point, and the Fed knows it. The cabal knows it. They know that they can't hold this thing together any longer because look what's happening to the petrodollar. It's falling apart. It's all happening from every single angle, and there's nothing they can do. This is why you need to be ready and prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.